Welcome to the next episode of Navigating Carbon, your compass to carbon management. As always, I'm your host, Deb Ryan, and welcome to our new season. It's going to be a great year. We already have some great guests lined up for the Navigating Carbon podcast, and I will also be continuing my conversations with Teresa on Common Ground. There are also some new projects in the works that we'll be working on and launching throughout the year, so look for those as we get ready to talk about them and to launch them. But without further ado, let me introduce our first guest. For this first episode, I sat down with Luke Hanley, the CEO and founder of 1089 Inc. 1089 is looking at the carbon markets through the lens of the transportation sector, both in terms of EVs and also the fuels. Luke's background in solar and EV space gives him a really interesting perspective as he's now working across the fuel space as well. And this insight allows him to think about how we bring together groups from both the renewable and the traditional fossil fuel sector to help decarbonise. Luke and I get in the weeds about methodology and also how 1089 is bringing insurance to provide security for carbon credits and what that does in terms of maturation of the markets and how it will allow buyers to start thinking about carbon credits as an asset class. To make sure you don't miss out on any new episodes, please make sure you like and subscribe to the channel. But for now, sit back and enjoy my conversation with Luke. Hey everyone, and welcome to the next episode of Navigating Carbon. Today I'm joined by Luke Hanley. Luke, how are you?
I'm doing so well, Deb. Thank you so much for having me.
No, I'm glad we've been able to make this work. You and I have been talking about doing this for a while, and so it's awesome to be able to sit down and have this conversation. So you're the CEO and founder of a company called 1089 Inc. Tell us, what does 1089 do in the market?
So 1089 is a carbon asset infrastructure company, which, sounds a bit opaque. Probably the best way to describe 1089 is in what problems we're addressing in the carbon market.
Okay,
And really from kind of three key pillars, which is trust, value, and liquidity.
I love that. Yeah. So let's dive into that a little bit more. So like when you say like carbon asset infrastructure, how are you guys setting it up to then drive those problems in the market and what you're trying to solve and stuff like that?
Yeah. So what's existed in the market right now is we've really transitioned, I think, from a compliance market into a voluntary space. And the problems that we've seen are downstream problems. So the first thing we want to do is address the biggest sector of impact, which is transportation and energy. Transportation representing, I think, back in 2024, maybe 1.5 million carbon credits that were generated in the VCM within transportation, where there was maybe 830 million in forestry.
Yeah.
So big gap. Emissions from transportation make up such a significant portion.
Mm.
And so we really wanted to focus on the accounting process, one, first from methodology, and two, the ability to transfer those assets downstream. And that's largely eternally using blockchain, which allows us to bring that through.
I love that.
The last piece is the value side.
Mm.
And, you know, in order to solve any problem, you have to assign some value to it. And that's been done. Now, in order for buyers to feel comfortable getting involved into this market, it's really about the transition into an asset class. And insurance is a key part of
Mm.
that. And so we've developed the first of its kind insurance policy for transportation and advanced fuel space that allows people to access scope 1 through 3 in a very meaningful way.
Yeah.
So that's been a huge portion because existing right now, you have surety bonds, you have ratings agencies that are involved. But for a buyer and for a project developer or generator, there hasn't been a product that's been created as that to protect both
Yeah.
and to really wrap the carbon credit as an asset class so that people can feel comfortable investing in these products without any sort of risk of greenwashing, liability, or authenticity
Yeah.
of the credit themselves.
I love that. And because you talked about the fact that, you guys are building trust, like the asset piece that you talked about, and then driving
Mhm.
liquidity into the market. You've made some pretty big press releases just this week, actually. So let's talk about that. Like, what did you guys announce
Yeah.
this week?
Oh my gosh. Yeah.
Yeah.
So incredibly exciting. So we've worked for the past 7 months with Oka, Price Forbes, and Lloyd's as an underwriter to develop the world's first carbon insured carbon credit in this transportation energy space, in the advanced fuel space. And it's, this has been a big push. We're incredibly thankful for all our partners who have worked with this and really seen the vision of how this can dynamically change the carbon investment infrastructure through really this financial asset that's wrapped in.
Yeah. I love that. So let's dive into like why the insurance piece is so important in like creating this asset class piece. One of the things I know you and I have talked about a lot, from like an analog or like, sort of comparison of what you guys are doing. I know you've talked a
Mhm.
lot about the early municipal bonds market and the rise of insurance there. Like, take us through that analog and like how it relates to what you guys are doing, and in that.
Yeah, no, this is great. A lot of times, you know, problems have been solved, and there's parallels in sort of financial history as we look at different industries. And a great one was the municipal bond market. Municipal bond market really saw a lot of the same problems that the carbon market had, which is for institutional investment to come in for infrastructure within a community. They had a really hard time addressing the risk and the risk profile of that community. So that really slowed the amount of investment that came into that space. And you look at it, each community is different. Leadership roles change, needs change. So in order for that transition from the muni bond market to go from very challenging to get these projects funded, and I think, maybe in 1970, that market was probably 25 billion. And by 1997 or so, it was up to about $1 trillion. And a large part of that was the involvement of insurance. Insurance got in, created that layer in between capital and structured project of infrastructure. And that allowed people to come in because you had that underwriting ability that existed. New York City is a great one. So, New York City, maybe uh, as one of the dominant ports of the East Coast, becoming really the dominant port, was from the mini bond market.
Hmm.
It was the infrastructure, the investment in the Erie Canal that started all of that off. That helped create that focus. It when we think about this as, historically, I mean, that happened before there was a Federal Reserve, before there was Wall Street, um, you know, and that market evolving, including insurance, has taken it from, a project that's over a century old to now a very robust market that has supported communities and infrastructure. I
Yeah.
mean, these are things like, clean water, utility, transportation, which has allowed growth within the cities themselves.
Yeah.
So, really critical piece.
And so I love that example because I think you talk about the carbon credit market, as becoming an asset class, but really in terms of financial terms, with like what is needed to really create that trust, which then brings the liquidity. So, like, can you just
Mhm.
explain, like, as you guys are thinking about the credit space in the transport market, like, why is that asset class so important for the liquidity and bringing that in?
Oh, great question. You know, transportation and energy is the largest emitter on the planet. I mean, this is the critical space that we need to address, and yet it it's been very difficult to get the participation and get this because for groups that are, already purchasing diesel fuel for transportation, for data centers as well, that are, running on a lot of diesel generation to close the gap before they get their interconnect agreements and permits to provide power from their local utility, which is also creating a lot of issues within areas that are looking at and seeing the smoke coming from these gen sets and saying, we didn't anticipate this to be what it is. But where it's I think critical and where we're at this turning point is this is a problem that we're all participating in.
Hmm.
We all drive our vehicles. We love ChatGPT, right? I mean, we love
Yep.
AI. We see where this is going. We love to travel. We are involved in it. And that transition from, you know, putting the weight on the largest emitters to say, you have to take care of this, while the people who are actually supporting those businesses continue to do so. Um, that thought has shifted.
Mhm.
Really, I think, I don't know, maybe from your side, if you've seen this, but, the past 5 years, the perspective of we're just going to stop all oil production, we're going to go full renewable, we're going to do this has come off the table. We've sort of aligned with a perspective of a very rational, scaled decarbonization. And our solution was really focused on taking the accounting and the methodology component of scoring the carbon credits from the generation point down to end user. So data centers using these, transportation using a lot of these spaces, gensets using a lot of these things, accounting through it, and then putting this on chain in our internal registry. We then create a digital twin that embeds the insurance wrapper with a policy number to each individual credit. And that allows for downstream transfer. So if I'm a company that says, I'm set to I've got to remove 100 metric tons of CO2 off the table. And I have the opportunity through just participation in our embedded pathway to say offset 120 million metric tons. That 20 million they can then sell to someone else to meet their needs.
Yep.
So it's really moving it downstream and creating that value.
Yeah, let's talk about this a little bit because when I first started in this space, I was really focused on the upstream piece. And I've seen actually the value of focusing on downstream because it creates that demand around this. Like, talk about why it was really important as you guys were looking at the credit kind of methodology and stuff from downstream and how you kind of built that methodology around the downstream kind of blending of fuels and stuff.
Yeah, no, that's an awesome question. So we take under an existing fuel pathway, and if we took CARB, for example, um, a lot of groups are using specific life cycle analysis for the production of ethanol fuels. And that segments out a large portion of the market. What we did is we said, we're going to take an average of the life cycle analysis across the country. And that's a key point in how we score our CI score, carbon intensity score, through our model to generate a carbon credit, because we believe that in order to solve issues of liquidity in this market and have it as a fair investment for the people to see outcomes so that there's a balance of risk to reward, we want everyone to participate. If we say to a farmer, you have to do regenerative ag practices in order to participate in this program, we're putting all of the weight on the farmer. The
Yeah.
expense is on the farmer. The risk is on the farmer. Whereas for us, we're saying, okay, we'll take a national average. Everyone can be, maybe they're not using regenerative ag practice, but if we solve the downstream liquidity problem, and really transfer carbon into an asset class that could be traded and held, invested in, all of those financial instruments, that then allows the farmer to feel comfortable investing in regenerative ag
Yeah.
because they know there's a financial outcome that benefits them. And as much as I would love to see that the world runs on goodwill across the world, you know, it's the incentivized nature, it's the financial benefit that allows people to go through, and I don't think that's a bad thing. I
No.
mean, I think people, we're all just trying to support our families. We're all just trying to take care of our communities, um, and I really think the structure that we've put together here is really instrumental to support both ends from upstream to
Yeah.
downstream in this energy market.
Well, and I think I love the example of the farmer because I think more and more the fuels energy space, it's not just
Mm,
fossil fuels. It is
mm-mm,
biofuels. It is like we're talking about life cycle analysis or even supply chains that are everything from traditional oil and gas down to fuels
mhm,
from biofuels and like even into the EV space when we talk about
mhm.
vehicles and things like that. And so I think the the way also that farming is so fragmented to try and have each individual farmer doing something and monitoring that and stuff is also not scalable. And so
No.
it's such a huge challenge, and it has been a challenge. You know, you sort of pointed
Mhm.
out some of this stuff in terms of how do we drive liquidity? How do we drive methodology that makes sense? Which
Mhm.
yeah, like it's something it's always been a huge problem in this space of all these different methodologies and stuff like that. So, um, anyway, so I think it's fascinating. I
Yeah.
don't know if you've got any
No,
other
no,
thoughts around that, but like
no, no,
it
no, I
is
do.
such a
I
huge
mean,
challenge. Yeah,
you mentioned the EV side.
yeah,
You know, EV is very interesting, right? It's been a bit of a it's been a hot topic certainly in the past year. Um, you know, EVs is a really good transition to energy. I mean, I think the big pushback has been, well, you've got an EV, you know, it takes a lot of raw materials for the batteries and there's emissions associated with this. What we're doing addresses those emissions from the mining all the way up through into the production. And people say, well, if you're running your EV vehicle on electricity that's being generated from a coal power plant, can you say it's clean? And you know, very fair question. It's part of a transition. So, yes, in some areas, and certainly looking at Egrade, you could see that this power is coming from a less renewable source or high emission source, but it's a single source which can be captured, sequestered, you know, managed in that space. That is a significantly easier problem to solve than it is to address every single tailpipe on the road,
yeah,
which from an emission standpoint, you know, is a lot. So, you know, diesel is a great example of this. You know, if we look at the DEF systems, which are using that urea spray into the exhaust to carbonize around and trap a lot of the emissions inside, and then it goes through a regen cycle, which heats up to insane temperatures to burn that off and capture it through. You know, that's a large expense.
uh-huh,
And that's an expense on the truck driver. That's an expense on the end user. If we were able to decrease carbon in fuel from the production facility, that's a single point that we can address, and that makes a lot of sense versus transferring the financial weight to the downstream
yeah.
participants in that
The
space.
thing that you talked about there that I think is something that I've heard multiple times as well is how do we think about the fuels or the products that are going through the supply chain versus the actual asset, which in this case is the car, which it's because it starts to always in this market, right? The conversation is like, well, who pays, right? And this idea of like, well, the
Mm,
consumers, you know, you and I are going to be the ones that pay for this. But by focusing on the fuel, i.e., the product, and how
Mhm.
that's being decarbonized, and how then that's much more business to business to kind of transaction versus business to consumer. And I think it's just really worth highlighting and pointing out then why that also, it's not just burdening all the costs of stuff on, talked about the individual farmer or the individual car driver, or, whatever that looks like. So
Yeah.
it's also just another piece of this market in terms of how do we think about assets like a
Mhm.
car versus the fuels that are needed to run them. But yeah, I don't know if, again, this is just my
Yeah.
ramblings now at this point
No,
because it's
no, no,
something that
no,
I've
no.
been really focused on. So
You know me, Deb. It's the fire hose.
yeah,
I'm in my best behavior right now. Uh, try, but it is interesting because right now the opportunity and where a lot of my vision in creating 1089 was is when I looked at the market, I saw that it actually it's really a accountability and trust and value to be able to track from here to here with multiple parties, but seeing where everyone is able to participate and then be incentivized. And all of it exists. It's the accounting component, it's the accounting, it's the structure, and it's the value integrity wrapper, which, the insurance piece really
mhm,
is a critical part of.
yeah,
So, you know, we're very solid, I think, on the world of, okay, what is the methodology of how we do this? How do we score what a carbon credit is in an additionality, saying this is traditional fuel, if we can drop the emissions on that by 10%, we've made a huge, huge impact. And within this structure of what we've created at 1089 allows for this to be into a participation model within an embedded
yeah.
ecosystem. And that's what's going to move this forward really, really quickly.
Yeah. So just talk about, you mentioned the insurance again, and I think as we kind of talk about this, the how the insurance improves the asset in terms of,
Mm.
let's talk about that because there's been some examples, and I know you come from a solar background and stuff. So sort of talk about like we've talked about the importance of insurance just to bring liquidity and build trust, but like it also improves the product, i.e., the credit itself. So talk about that, like, and why that's so
Yes.
important.
So from our side, when we look at finding a solution is, I always say like I've very rarely been successful at convincing someone to change their mind. But if I create the pathway to be incentivized to do so, then that's how a lot of it. So it's between thinking green for the trees and, thinking green for what's in people's wallets, because that liquidity component is the great connector across through the stream. And when we look at, I mean, from a side of as like a simple question, we were speaking recently and someone asked a very similar question. And I thought to myself, okay, what is the question to help other people get to a realization and say, what kind of car would you buy if that no one had insurance on the road?
Yeah.
And we can go to other countries in the world. And the answer is it's the cheapest car to fix because accidents happen,
Mhm.
mistakes happen. And so how do we, how can we have a market grow and ask people to invest more in this market and support this decarbonization pathway without giving them a safe path forward? I mean, when we look at the vehicle space, I don't think people would buy, $100,000 cars if someone could hit them and they go through and they end up paying 30 grand to replace whatever part
Yep.
of it. It just wouldn't happen. So, we explain it. We spent a lot of time on communication, but it's, the world of finance and the language of that when it's put in simple terms and brought into real life, like the car example, um, it it makes it and brings it home, and it becomes not so much a complex economic theory of asset liquidity and, financial instrument embedding. And it really just comes down to, this is a common sense thing that we all can kind of
Yeah.
understand. And we're capturing this moment to be able to, where the energy producers, the public, policy compliant, all are aligned to capture this and benefit,
Yeah.
because we're all part of it. I mean, we're all creating emissions in what we're doing. We're all supporting all of these supply chains and what we buy. And soon here we're going to have a way for retail participants to actually get involved in that side of it.
Mm.
So imagine a world where you can buy products with carbon credits through that piece. So companies are acquiring their carbon credits to meet their ESG goals, whether it's a compliance in the EU or around the world, or, investor commitments. A lot of these groups we've seen, and we could go into this, but, a lot of these companies are going through a lot of issues. Their investors have, required them to make commitments in order to receive the capital they have investment to grow. They haven't met those commitments. And so they're starting to get broken and parted out,
Mm.
and it's creating a lot of friction. So if they can, through their existing embedded ecosystem, capture that value, and we're able to have retail component and individuals who are also participating in this market have value. I think we've done a meaningful thing to solve this problem.
Yeah, which is awesome. So let's, as we're kind of getting towards the end of this, so like, tell me, like, where do you see this going? You sort of started to allude to like some of the future of like individual consumers having, the ability to use carbon credits and stuff like that. But like, what else do you see coming down the pipeline as we think about what's next, both for 1089, but for the markets more broadly?
Oh, okay. Wow.
Just give you a very open-ended question. Off
Yeah,
we
no.
go.
So you give
Yeah,
me an open end and you're like, and
and go.
run all
Yeah.
directions. Okay. The way, kind of interesting thought on this is, right now, this system has been set up from a compliance market, right? That really pushed in ESG goals into the corporate DNA. And that's why the voluntary market was set. It's like, hey, this is where we can do. Here's some other things we could participate. The voluntary market is really a reflection of the will of companies to address this issue where compliance didn't meet, saying, hey, we know we don't have to do this, but we're going to. So they created other areas that they can address this in. The next component is we created the registry about to track and make sure, check on double and triple accounting and make sure that everyone is doing what they say they're doing, and the things that the buyers are getting is what they are
What they thought they were
saying is,
getting.
yeah,
Yeah.
what they was going to get.
Yep.
Um, the next step for this market is, we really see the transition into, from multiple rating agencies saying, we give you a gold star, we give you a gold star, into a space where this is really an asset class,
Oh,
where we see now buyers coming from corporates. It's going to be institutional buyers buying large tranches of credits and then distributing to their partners,
oh,
because,
that's cool.
which is kind of an interesting
Mm.
scope. It's going to go from individuals, because there's an alignment, and we don't spend a lot of time talking about sequestration or capture, but a lot of groups that want to invest in this technology for decarbonization, the people who are lending them money they're lending them money. They're then getting back the investment tax credit through the project, 45Z, 45Q. The other component that they'd like to get back is the carbon credit value.
Mm.
And, up until bringing insurance involved in this, that value wasn't looked at as part of the repayment on that amortization schedule for the equipment being financed to go through. So it it becomes a situation where this downstream market is going to move into institutional investment and also retail participation. So if you drive an EV, if you have solar on your house, if you are operating in a way where you're able to get value for participating in this decarbonization solution, it's really, and what we've done is create the pathway for companies to embed that into their existing business model.
Mm,
So we're not asking anyone to say, they have to change what they're doing. They require a large, consortium to solve massive problems that have, rippling effects to their existing business. We're saying you can do this. And if we create value in this stream and we solve the downstream problems, then that's going to encourage that company and certainly on the fuel side to invest in more low carbon fuel
mm,
solutions, to invest in more ways to minimize environmental impact. And that then can move down to farmers, to suppliers, but it is the downstream piece, and that's where we are in this market. And I think in the next 2 to 3 years, how carbon is looked at will be more akin to a asset class, investable instrument, and something that we are all participating in.
yeah.
And I'm incredibly excited in the things that we've been involved in, and certainly, from the Transportation Energy Institute has been really instrumental in helping us develop the EV methodology and the advanced fuel methodology, and also just as awareness of what's happening in that space from some of the largest energy companies in the world has given us an opportunity to see the landscape and really laser focus in on what the problems are and how to benefit both people.
Yeah.
And every solution that involves where everyone wins is the solution that 1089 wants to be involved in.
I
And
love
it's
that.
going to be, oh, thank you.
I love that. So, no, look, it's been an absolute pleasure. So no, there's so much going on. As we see some of these things emerging and changing and stuff like that, we'll have to get you back on and see how things have evolved and where we are. Like so, but no, it's been great. I appreciate your time.
Oh my gosh. Thank you so much, Deb. I appreciate it. Always a pleasure. And I can't wait to more conversation.
Cool.
Thank you.
Thanks.